On May 28, 2026, Anthropic closed a $65 billion Series H funding round at a $965 billion post-money valuation. Anthropic is now the most valuable private company on Earth, having overtaken OpenAI's $852 billion valuation from earlier this year. 14 months ago, the company was valued at $61.5 billion. Today, that figure sits at nearly $1 trillion. This 15.7 times increase in value has no precedent in enterprise software history. For comparison, Salesforce spent 2 decades reaching the revenue levels Anthropic just bypassed. Speed and scale of this magnitude lead many observers to conclude the market has reached a bubble peak, assuming the valuation is driven by speculative mania rather than financial fundamentals. However, the most significant details are found in the middle of the press release, away from the headline valuation. Anthropic is allocating this $65 billion to massive multi-year infrastructure procurement. This is a capacity round, a financial strategy designed to secure the hardware required to handle massive future workloads. While the company anticipates remaining unprofitable until 2028, that deficit is the result of front-loading the cost of data centers and processors. Assessing Anthropic's true financial health requires looking past equity valuations to analyze their hardware supply chains and revenue multiples. In typical speculative cycles, valuations climb while actual revenue stays flat, causing the company's price-to-sales multiple to expand. Anthropic is exhibiting the opposite pattern. Their revenue growth is actually moving faster than their valuation. In December 2024, the company had a run-rate revenue of $1 billion. By the time they reached their Series G round 3 months ago, that number was $14 billion. This chart compares valuation against revenue. In just 14 weeks, Anthropic's revenue jumped to $47 billion. Consequently, their multiple dropped from 27x down to 20.5x today. For comparison, OpenAI sits between 30 and 65 times revenue. Even though Anthropic is now the larger company by valuation, it trades at a significantly lower multiple than its primary rival. This compression suggests that the valuation is being pulled upward by actual revenue growth, which is generally the sign of a maturing market rather than a bubble. This $47 billion figure does require a specific accounting adjustment to be understood correctly. Anthropic reports revenue from cloud resellers on a gross basis. As the Sankey diagram shows, end customer spend through Amazon and Google is counted entirely as Anthropic's gross revenue. A significant portion flows right back out as partner payouts. Recording spend before deducting expenses inflates top-line revenue compared to net reporting peers. While the 20.5 multiple is factually accurate to Anthropic's disclosures, it appears more favorable because of this gross basis reporting and should be weighed accordingly. The strategic partners named in the Series H announcement provide a clear signal about the company's current priorities. Anthropic highlighted memory giant Micron, South Korean manufacturer Samsung, and competitor SK Hynix. These companies manufacture high-bandwidth memory and storage chips, the physical components necessary for training and running frontier models. Elevating hardware manufacturers to the level of strategic partners indicates that the primary constraint on Anthropic's growth has moved to the physical supply of chips. Anthropic has signed a series of multi-year infrastructure contracts that represent a staggering long-term liability. Current commitments include 5 gigawatts of Amazon capacity and 5 gigawatts of Google and Broadcom TPU capacity. They've added SpaceX's Colossus and a $30 billion Microsoft Azure commitment. Including FluidStack, Anthropic has committed to over $200 billion in infrastructure. The $65 billion raised in the Series H is a down payment on a bill that is more than 3 times larger. Operating this much hardware requires massive amounts of electricity, with these commitments representing enough power to run several mid-sized cities. The company's current losses are tied directly to this expansion. They are buying the capacity to handle future demand that is still materializing. Major institutional investors like Sequoia, BlackRock, and GIC have anchored this round. By writing these checks, they are backing the thesis that enterprise AI demand is a permanent feature of the global economy. This shows the true risk. On the left, the revenue curve needed to stay solvent. On the right, the rigid cost of compute contracts. If enterprise demand normalizes, the revenue curve flattens, but massive hardware costs remain locked in. CEO Dario Amodei has been transparent about this risk, stating that even a 12-month delay in AI progress would result in bankruptcy. These multi-year compute commitments are roughly the size of a small country's GDP. Once signed, they cannot be scaled back. The next 2 years will determine if Anthropic can find enough paying demand to fill 10 gigawatts of hardware before their capital is exhausted.